How's it going, everyone? Welcome to the sweep. My name is Hiram Cherez, and I'll also be bringing in my business partner, Tim Coblin, here in just a moment. So let's go ahead and get started. As usual, we'll go ahead and start with disclosure. So go ahead and take a minute, take a look at that if you'd like, and we'll go ahead and get going. As always, if you guys have questions, feel free to chat those in, and we'll get to them at some point within the session. All right, awesome. Okay, let's see. Good. I want to make sure I'm not going to pick up any background noise there. All right, awesome. So as usual, follow us on social media, like, share, and follow on Facebook, Instagram, YouTube. If you're on YouTube right now, you're watching on YouTube, make sure that you hit that subscribe button, and that way you'll be notified when we post new content, when we're going live, things like that. We may be doing some more impromptu live sessions as well, so something to keep an eye out for. And then also, if you guys have questions beyond that, you can also email us to info@daytradesmart.com. Now, here in a moment, I'm going to introduce my business partner, Tim Coblin, who is co-owner of Day Trade Smart with myself, and he'll be doing a weekend review with us, and then I'll pick up after Mr. Coblin is done. And of course, if you guys have questions for him, feel free to ask, and I'll be monitoring questions as well. So let me go ahead and pass this off to Tim. And okay, let's see. Okay, and then Tim, you can just go ahead and take over the screen if you want. So if you go up top, it'll give you an option, just take over the screen, and then I'll mute myself, and you'll be all set to go. Yeah, so there's a button to share screen. Sorry, guys. We're still getting used to all this Zoom stuff. Give me 1 second. Press escape for a second. There we go. Okay. There we go. All right, Mr. Coblin. And then make sure you unmute, and I'm going to mute myself.
All right, everybody. Hi, I'm Tim Coblin, co-owner of Day Trade Smart. We're just going to kick back here and do the week in review. A couple things we want to go through: the basics of reading an economic calendar. This is one of the most important things that you're going to want to do before you start your trading. It's because it's going to tell you everything that's going to be happening throughout the day and the week. So you're going to know exactly what announcements and what impact they're going to have. Now, we don't trade announcements, and we'll tell you why here in just a second. But going over them, and on the FOREX factory is one of them, what we use. We have a gray flag, a yellow, which is low impact, an orange, which is medium impact, a red, which is high impact. So we stay away from all the reds. Some announcements, although not in correlating pair, they may affect all pairs. And an example of that would be if you would see something like the Fed chair. When Powell speaks, people listen, trust me. It's going to affect every pair. Now, it does give you what exactly it's supposed to do, the usual effects. But trust me, the big banks are looking at this and saying, okay, well, if they're going to do that, we're going to take you for a ride the other way. So that's why we try to stay away a half an hour before and a half an hour after all announcements. There are companies that trade just announcements, but we've found that it's safer just to stay away from them. Our recommendation is to refrain from trading at least 30 minutes prior and 30 minutes after any major announcement, and never trade an announcement. So we want to err on the side of caution, or err on the side of caution. We recommend using more than one source for an economic news. We use FOREX Factory, and we also use dailyfx.com. Dailyfx.com is a little easier to read. It just tells you high, medium, or low impact. So it's more preference on which calendar you like to read. I've been doing FOREX Factory for 10 years, so I'm just kind of used to looking at it. You can look up past trades, find out why a trade did something when you're back testing. We've gone over back testing a little bit. So, like I said, we have forexfactory.com, dailyfx.com, and cnbc.com. We use news feeds for finding out why a trade did well or didn't do well. We like CNBC just because it's all right here on the top. It's not whether we're conservative, liberal. It just has all the stuff we need right at the very top of the page. It gives us a quick idea of what happened. So it's not good you're not going to be able to make a trade based on the news that's happening because it's always after the fact, but you'll learn a little bit and be able to see that if something like this is going to happen in the news, you might want to stay away from a trade. So it's just a good idea to get used to learning what the world is doing all day. You're not going to have much of a choice. So our company, Day Trade Smart, we have alerts that we send out daily. And as you can see, we have several different kinds of alerts that are based on patterns that we've back tested over the last 5 years. And each one of these has at least a 70% accuracy rate, or we're not going to do it. Now, it depends on the time of day, and you're going to need to look at your other time charts to make an accurate reading on these. But it's nice if you don't have to look at your screen all the time. And when you get an alert, you got 5 minutes to take a look, figure out if you're going to make the trade or not, and then make that trade. So last week we received 176 alerts, and this is basically how they performed. 41 of the alerts didn't remain until the top of the hour. So we need to wait until the post before we make the trade. So we want that pattern to stay for the full hour. So if you see it at 20 minutes after the hour, you're still going to want to wait till the post to make sure that pattern stays. So 41 of these did not stay. 23 of the alerts did not have backtest viability that's over 70% or better. So we want to make sure that the alert that we have is at least a 70% good trade. If you've taken every single one of these trades over the last 5 years, it ended up 70%. Although we provide backtest data for some patterns, we expect our students to learn how to backtest these for themselves. That's very important because that's how you learn to read our proprietary indicators. And once you learn how to read our indicators, you don't have to rely on the alerts and the patterns that you have. You'll be a discretionary trader. You'll be able to look at these indicators and say, hey, I'm going to take this trade right now. Could be a quarter after. So here's a list of patterns which we alert, but expect our students to backtest and determine what parameters are most profitable for them and the time of day that they trade. So these were named by our students. So one is a half top. We had 5 alerts, 3%. We had head fakes, 5 of those. A hiccup, which was our very first pattern that we found. This one had 37 alerts, so 22% of those. Our turnover had 10 alerts. The remaining 55 alerts performed accordingly in chronological order. Each alert has a risk percent associated and is based on a win percent for that setup on that pair. For buy, sell, and a specific time it occurred. Time shown are the time of which the trade would have been executed. So it could have been there for an hour, but the time shown are the times which the trade would have been taken. So if we're looking at the charts, you can see our last one happened at 1:56 Mountain Time, but it was 1958 UTC time, and it was a classic. You'll notice that a lot of times we have patterns such as dirty pressure that happen several times during the day. So even if you're just practicing on one pattern, you have 5-10 times a day that it comes up, you're going to be able to get 1 or 2 of those trades. So it's important to learn how to recognize the pattern and then go to your different time frames to make the trade for itself. So that's it in a nutshell, 1 week's worth of our trades and how they did. Hiram's going to show you the spreadsheet on exactly how often these trades came. I don't have them on my computer, but I'm going to turn it back over to Hiram, and he'll pull up those charts and show you exactly what happened. So I'm going to send it over to Hiram right now.
All right, awesome. Thank you, Tim. Appreciate that. So what we're going to do is we're going to look at how some of those alerts fell out last week. And the reason why we did it for last week and not this week is because obviously right now is the sweep. So at 3 o'clock, the market closes. And so we would have had to compile all of that information, between the entire week and then the rest of today, and then put it through the analysis that we kind of ran for you guys. So obviously there's not enough time to do that for this week. If we were going to show this week, we could show it, obviously as early as, next week, beginning of the week or what have you. But just to give you an example, we wanted to just kind of break these down for you guys so you guys would have a good idea of kind of what that would look like in a real time type scenario. Now, obviously, this is taking the assumption that we would have taken every single one of these trades, which, may not very well be the case, right? Most people have 9-to-5 jobs. There are other things that could very well, prohibit you from taking every single one of these trades. But obviously, we don't know what times exactly you're trading, and you may be trading at certain times where other people aren't trading. And so we just decided, okay, let's just compile the ones that did happen that people would have been able to take using our backtest data, namely our students, and break those down chronologically. And the reason why we chose to do them chronologically is because that's the only way that it really matters, right? So if we just took the overall win percentage, there's no really way of telling how that would fall out in terms of profitability. So all these red marks right here would constitute a loser. Okay, so you can see that we lose trades just like anyone else, just like anything else. There's no 100% system, right? And again, you guys have heard me say this. If somebody claims to have 100% system, you should probably run the other way because they're full of it, right? So we can see that we started off with a turbulent start, right? First 2 trades in a row, boom, boom, back-to-back losers, right? One of them would have been for 1% because its win percentage was 71% with a 0.9 to 1 risk to reward. So that's a little better than a 1 to 1 risk to reward. And then the second one was a 75% win rate with a 0.3 to 1 risk to reward. So we just used the assumption of a $10,000 account, and that means that this first trade would have been worth $100, and that would be your lot size in dollars would be $3.80 per pip. And your stop loss would have been 26 pips, and that would have equaled $100. So it doesn't matter if it was 26 pips or 56 pips or 2.6 pips, it would equal $100 based on the lot size, right? We've talked about that, right? This number is not as relevant as what each pip is worth, right? So that was a loser, and you can see that came off the balance. Now the new account balance reflected the 2% risk that we would have been taking on this next trade, right? So we wouldn't have taken 2% of 10,000 anymore. We would have taken 2% of 9,900, right? Because that's our new account balance. That being said, we had that one lose as well, and that brought us down to $9,702. And then we had a nice streak of winners, which brought us out of the red and into the black. Right here, just barely 77 bucks into the black, and then whoops, another loser, right? 1% of 10,077, and that gave us our profit, our loss in that case, and we deducted that from our balance and then went on to our next trade. Nice little streak of winners there, which then brought us back into the black. And you'll notice that after this point right here, after this $9,977 balance, after that loser, from that point on, we would not have gone back to below $10,000. Everything else beyond that point would have been above our starting balance. So whether it was $1,000 or $10,000, whatever it might have been, right? Because we're using a percentage of our account. So it doesn't matter if it was $100 or $1,000 or 10,000 or 100,000, right? It's still going to be a percentage that we would have been risking. So at this point right here, we would not have gone back below our 10,000 mark. So we're at 1048, 10,118, so on and so forth and so on. Took a step back there, right? Because we took a loser, and that brought us from 10.6 to 10.2, and then back up again, and then step back. And then all in all, when all was said and done, you can see none of these were below that 10,000 mark. We actually got into the 11,000 here. We would have ended the week with 11,344 had we taken those trades. So that would have been $1,344 increase on our account in 1 week, right? Now that's obviously hammering out all those trades and then seeing their fallout. Now, naturally, you may only be taking, some of these trades, but you can see that, I mean, if we put this on a dartboard, it's more likely, obviously, that you're going to hit a winner than you're going to hit a loser, right? And then that's not how we want to trade. We don't want to take that approach where we're just doing it at random. But you can see that overall our win percentage was 74%. Now we've had weeks where it's much higher than that, right? 80, even 90%. And we've also had weeks that are lower than that, lower than 74%. But we don't generally have weeks where it's below that around 70% mark. We're going to stay pretty consistent in that and above 70%, which is consistent with our back testing, which is why it's so important to do that back testing, right? So we have that data that we can trade with. So awesome. Just kind of want to break that down for you guys so you guys can kind of see the real life, example of what that would look like. Now, this is obviously playing very conservatively because we're all across the board with different currency pairs, different setups. Now, normally a trader will just take, a certain setup on just a few of these hours throughout the day and likely have a higher win percentage and more value at the end of the week, month, year than that. But if we just kind of blasted that out there, just took all of it, we could see that we would still have been profitable, which is obviously a positive thing. And we could see that our backtest data would have held true, and we stayed within those. You can see that most of these trades are within that 70, 80% range. There are some in here that are a little bit higher, 88. I don't think we have any 90s in here. We may have one, but they range all across the board. And based on that, win percentage is how we're going to justify the risk percentage. So you can see it's 89%. That would have been at a 4% risk versus something that was at 1% because it was, 72%, for example, win percentage. All right, awesome. So just kind of wanted to break that down for you guys really quickly. Let's go ahead and get into our session we're going to be covering today, which is going to be how to choose a broker. And we had talked about this. We got a lot of questions about this after kind of alluding to it, in the past. And I want to be clear, so I brought this disclosure back up. We are not an introducing broker, and we make no recommendations as to where you should invest or what broker you should trade with. Okay. So we don't make those recommendations. So we're not going to give you a name of a broker or anything like that. But what we can do is tell you the things that you should look for when evaluating a broker, right? What things would be prudent for you to consider when you're looking at a broker. So I'm just going to take a little bit of time here and we're going to discuss that, right? But I did want to preface by saying we are not an introducing broker. We don't make broker recommendations. Now, when our students trade our corporate funds, they do trade out of specific brokers that we have money with that we use to fund corporate funded traders. But even that in and of itself is not us giving a recommendation as to where you would trade your own personal money. Obviously, you can do it in the same place that we do it, but that's entirely up to you, and we don't want to make any specific recommendations in that regard. Okay, so what you should consider when looking at a broker, right? So you're looking for, and we're going to keep it at FOREX just because that's kind of where we started, so we're just going to continue with that, right? So what should you consider when you're looking at brokers? So are they reputable? So when compiling a list of brokers from which to choose, check to see what others might be saying about them. It's also a good idea to see how long they've been in business, right? And consider that if you've been in business long enough, there's going to be both. There's going to be good and bad things that are said about you. So you have to consider those things. Some things that you may want to take with a grain of salt is when they talk a lot about regulation, right? Now, is a broker that's not in the United States going to be regulated by US regulations? Yes and no. Okay, so they have to do business with a U.S. client, there's certain regulations that they have to abide by, but there are other regulations that they don't have to adhere to, which is actually a good thing for retail traders. So don't get caught up on that, on that buzzword that people like to throw around. Oh, they're not regulated, because when you press them on the matter and ask them, well, what does that mean? They don't really know what that means. They just think, okay, well, if they're not regulated, then it means that they're not safe. Well, no, that's not always the case, right? If there's anything that we've learned recently is that more bureaucracy is not always a good thing, right? The more regulations we have aren't necessarily freeing, they're restrictive, and that's the idea. But a lot of times those regulations are on behalf of or to the detriment of the retail trader, you, me, us, right? We look at the example of Dodd-Frank, for example, and there are a number of other examples that we could look at that these quote unquote, regulations that are supposed to benefit us are actually detrimental to us. So yes, you want to keep an eye on that and make sure that you can actually do business with them as a U.S. resident, but try not to get too hung up on the regulation type stuff unless you know what it means, right? And I would definitely recommend that you guys go out and do your research on that kind of stuff and figure out what that means, what regulation means, right? When they talk about whether or not a broker is regulated. But you want them to be reputable. You want them you want to make sure that they've been in business for a while, that they're not, they didn't just appear one day and they may disappear the next, right? Liquidity partners. So a great way to look at whether or not a broker is, going to be consistent and viable is looking at their liquidity partners. So if they have partners with deep liquidity pools like mega institutions, they're only likely to do business with brokers that are going to be trustworthy, above board, right? If they're these mega institutions, they're not going to, participate or partner with these, other brokers if these brokers are doing anything shady, right? So that's a good way to tell if the broker that's on your list is something that's going to be viable. Look at their liquidity partners. Leverage. You want to find a broker that allows more than a 50-to-1 leverage. And if you guys remember any of our other sessions, you'll know why, right? You don't want to be limited by that leverage, because for one, it causes for you to have to use a smaller lot size than you would otherwise be able to use, in a trade or multiple trade scenarios. So we always recommend at least a 200-to-1 ratio. I wouldn't recommend more than that. And in one of our other videos, we talked about what leverage was as well. So 200-to-1 is just saying for every dollar you have in there, you're able to leverage $200. Now, it's not that you want to use all of that amount in your trading. On the contrary, you'll use just a fraction of that per trade, but you want to be able to have the option of putting in multiple trades at the correct lot size. Like we were looking at that chart, we want to put in a 1% trade or a 2% trade, or two 2% trades, right? Or two 2% trades and a 1% trade, whatever. We want to be able to have multiple trades open if need be. Right. And a lot of times, if you've got that minimal leverage, you really run the risk of getting those margin calls and getting taken out of a trade because you don't have that buffer. So we'll never use the whole amount, but the extra leverage works as that comfortable buffer in instances, especially in instances where there's multiple trades involved. Right. So just some quick math that we were kind of doing in one of the other sessions with a 200-to-1 leverage. If we took a trade, let's say on the Euro USD, let me use a different color here. Let's say we took a trade on the Euro USD and we used a 1.0 lot size on, let's just say a $10,000 account. Well, that would use in your free margin with that 201 leverage, if the EU is 100% margin requirement, because each currency pair, like we talked about, have different margin requirements as well, right? So you're looking at about $650 roughly, right? $650 of free margin. And this is how basically they ensure that you'll never get to zero in your account. So if you lost all the money up to the point where you got margin called, you would be left with $650 of a $10,000 account. So that's kind of like the let's call it like collateral, right? To place that trade at 1.0 lot size is $650. Obviously, if it was a 0.1 lot size, it would be $65, and a 0.01 lot size would be $6.50 of free margin that you're using up. Okay. Now, if we were on a 50-to-1 leverage, right, then we would be using up 4 times that amount. Your collateral would have to be 4 times that amount, right? So if you had a $10,000 account, this would be 12, 13, 26, $2,600 that you would have as collateral to place a 1.0 lot trade, right? So if you had 2 or 3 trades, you could see how that could get to pretty close to $10,000, using up all of your account balance just to place those trades, right? So is it that we want to put in larger lot sizes? No, it's just we want that comfortable buffer so that we're not anywhere near margin calls, especially in instances of multiple trades. Okay, so just some food for thought there. You definitely want to have something that's greater than a 50-to-1, or at least have the ability to move up to something greater than a 50-to-1 leverage when trading in the Forex market. The next is commissions and spread. You want to have a combination of both. You'll find that you can find certain brokers that will allow no commission, but then the spread is larger than you could potentially get it somewhere else, right? And the spread is just the difference between the bid and the ask price. So if I put in a trade, let's say here at, I don't know, 1 point, I'm just going to make up a number here, 19.724. And the spread, and this, let's say this is the Euro USD, and the spread is, let's just say 1 pip, then, and I'm taking a buy, right? Then I would get put in at 1.19734, right? So I'd be starting 1 pip behind, basically, right? Because I wanted to get in at 2.4, but the spread is 1 pip, so now I got in at 3.4. And if I'm only going for a scalp, 3 to 5 pips, in terms of pip value, not scalp in terms of how long it takes, but just in terms of pip value, that's 1/3, of my profit right there, just in that spread, which means, I've got to get that extra, right? And so a lot of times you'll find that you can find brokers that have no commissions, but larger spreads, or you'll find others that have smaller spreads, micro spreads, but bigger commissions. And then there are others that have a good combination of both. You'll have low commission and low spreads. So in this example, you would versus paying no commission or say, a $6 commission for a 1.0 lot size, you would pay, say, a $2 commission, right, for a 1.0 lot size, and have micro pip spread. So instead of a full pip, maybe on the Euro USD, it's like 3 micro pips, right? So you get put in at 1.19727, right? That number changes, the micro pip, which isn't that much of a difference, right? Especially when you're scalping. So having that small commission, small spread is what's most ideal. And I don't know that anybody would disagree with that. Because especially towards the end of the day or when liquidity picks up, spreads do tend to increase a little bit. They fluctuate, right? They're not always the same, but most of the time you'll find that they'll stay within those respective ranges. So if, for example, one of the brokers that I use has a 2 micro pip spread for the Euro USD. That's pretty consistent throughout the entire day. There are instances where it's increased, but not anything that's too outlandish, except for perhaps at the end of the day during the sweep, right? When one day ends, the new day begins in the Forex market because it's a 24/5 market. At that time, generally the spreads across the board will go up significantly. Sometimes just outrageous, right? Instead of 2 micro pips, maybe it's 5 pips, or some currency pairs that have a pip of spread normally will have 10 or 15 pips a spread. So that's something that you want to be cognizant of. But also, if you have smaller spreads to begin with, when you do have those fluctuations and they do fluctuate to a larger spread, they're not going to be so outlandish, right? Okay, so choose a broker with a combination of low commissions and low spread. So like we were saying, for example, less than 5 micro pips a spread, and commission of $2 to $4 per 1.0 lot. We always use the example of the euro versus US dollar, just because it's one of the most commonly traded currency pairs. It's actually the most traded currency pair in the world, right? In a over $6 trillion a day market, which is the Forex market, the largest market in the world, the Euro USD accounts for 1/3 of that liquidity exchanging hands. So 1/3 of that goes to the Euro USD alone. So that's pretty huge, and that's for a lot of people is the standard essentially, right? I mean, if you trade in Forex, you've traded or currently trade on the Euro versus US dollar, and there are some people that trade exclusively on the Euro US dollar. Matter of fact, we have coaches that coach our students that are familiar with how to trade other currency pairs and know how to teach it, but they've come to a point now where they only trade on the Euro versus US dollar. So that's why we always talk, a lot of the examples we use are based on that currency pair. Okay. And micro lots. Okay, for the sake of being able to trade with a low starting balance and or the ability to compound your earnings, you'll want a broker that allows lots as low as 0.01 lots. Okay, so the way that plays out is if you've got a small account, let's say that, I mean, with Forex, some brokers will allow you to start an account with as little as $100. Okay, so let's say you've got that $100 account. All right, and you want to trade, 1%. It's been a long week, man. All that yawning. You want to trade 1% of that $100 account. That would equal $1, right? So you want to risk 1%, which is $1. Okay, and you have a stop loss that's let's just say 10 pips. Okay. So your lot size to equal $1 would have to be 10 cents per pip, right? Because 10 cents 10 times equals $1, which is 1% of 100, right? So 10 cents per pip is 0.01, right? If this is $1 per pip, then this is, or I'm sorry, if this is $10 per pip, this is $1 per pip, right? 1.0. This would be $1 per pip. And this would be 10 cents per pip. So if you can't put in a lot size that large, it's not likely that they're even allowing for you to start with a $100 account, right? But let's say hypothetically that's what you've got. Well, then you want to be able to utilize the correct win percentage and be able to, place a trade small enough so that you're able to enter the market even with a small account balance, right? The other one, and that this is actually much more important than that, is you want the ability to compound your earnings. Okay, so let's look at the example, and we've looked at these before. If you guys have watched, Day Trading for Beginners, that series, anything like that, we've talked about this. Where in, say, the futures market, which we also trade, we trade futures as well. But in the futures market, you have contracts, right? And you trade one contract, or you trade two contracts, or you trade three contracts. You don't trade 1.5 contracts or 1.01 contracts, or even just 0.1 you got to trade one contract, two contract, three contracts, right? And with futures, you want to start off with at least a $25,000 account. So it's not very conducive if you're just getting started in trading, and maybe you don't have a lot of capital to start with. But in addition to that, if you want to start trading two contracts, then you need your account to grow to 50,000, which means you need to win, right? If each contract is, say, is worth 1250, right? Let's just say you're taking quarter pips, or ticks, right? Quarter points. Then each of those are going to be worth 1250, right? So a full point would be like $50, right? So that means that in order to get to a point where you are back to 25K, right, you'd have to do, let's see, 10 of those winners. Obviously, it would just be winners, would be 500, right? So 100 of them would be 5,000, right? And so you can do the math, right? 10,000 would be, 1,000 of them, or whatever it might be, right? So you can see it might take you a long time to get to 50 grand so you can start trading with two contracts, okay? Now with Forex, you can take, every trade like we're seeing on that sheet, right? And compound the earning. So that means that versus just trading one contract, one contract, one contract, one contract, so on and so forth, I can do, one contract, or one, 0.69 lots right here, and then increase that to something that is incremental to just whole contracts or whole lots, so that I can compound my earnings, right? So now I'm not just trading one lot at a time. Maybe my first trade is 1.0 lots, or maybe my first trade is 0.01 lots, right? But after a while, let's say if I had that $100, I've made enough trades, and I mean, with $100 it's tough, right? Because you'd still have to double that number. But let's say it's $1,000. Well, $1,000, then my lot size in that example we were using before is 0.10 for that first trade. And let's say that first trade netted me $100. Well, then my next trade I could do at 0.11. So each trade or each sequence of trades then become more valuable. Even if I'm not taking more movement, I can still take the same amount of movement, same amount of risk, but make more per trade, which allows for me to get to, doubling an account much quicker, right? To give you an example of the power of that, if you traded just at a 70% win rate, let's say, for example, which is a stretch for the vast majority of the industry. But if you trade at a 70% win rate, like our students do, our students are trading 70 and above, right? And you're using, say, a 1-to-1 risk to reward ratio, that means your stop loss is equal to your take profit. And it doesn't matter if it's 2 pips or 20 pips or 200 pips, right? It doesn't matter, because the next number, which is the risk percentage, is what matters, right? So if you're trading 70% 1-to-1 and you're risking, say, 2% of your account per trade, and you're taking about 2 of these trades a day, okay? Within a month, just over a month, you'll double that account. Okay, 70% win rate, 1-to-1 risk to reward, 2% risk. Okay, so this is risk. And it doesn't matter if it's 2 pips or 20 pips or 200 pips, because it's still just 2% risk. So if I had a $100 account, right, then that 2% risk would be $2. If I had a $1,000 account, it would be $20, so on and so forth, right? So it doesn't matter if it's 2 pips or 20 pips. This could be 200 pips. This number could be 200 and 200, a 1-to-1 risk to reward ratio. But I'm still only risking 2% of my account, which means it's still going to equal. I mean, I wouldn't be able to put that trade in because I wouldn't be able to use a lot size small enough to take a 200 pip drawdown. But let's say that we had, a $10,000 account. And I wouldn't ever recommend a 200 pip drawdown anyway. If you can't get it, and if you can't get the trade in less than 50 pips, you're probably doing something wrong. Like, you're definitely not, you're not targeting it correctly. You're not entering correct. And that's gracious, guys. 50 pips of drawdown is gracious. Okay. If you're not getting your trades within that swing, you're doing it wrong. There's definitely something that you can improve on. But let's say it's a $10,000 account, right? At 2 pips, 2% is going to be $200, right? So $200, and that's going to be $200 in 200 pips or $200 in 2 pips. It doesn't matter, right? So if it was going to go 200 pips, then the lot size would be a 0.10, right? That's $1 a pip, 200 times $200, 2% of 10,000, right? If it's 2 pips, then the lot size is going to be like 20, right? 10.0, not 20. 10 lots, right? 10.0, which is $100 per pip, 2 times, which equals $200. Okay, so it doesn't matter how much movement you're getting if you've back tested it and your numbers are sound. So you're able to compound. Obviously, you're going to be able to take a 2 pip trade multiple times a day versus 200 pip. But if you're able to compound these, right? So if this is all equal, but you're only able to take this 200 pip trade, once a week or twice a week at most, but this 2 pip trade you can take twice a day, 3, 4, 5 times a day, then you're going to be more successful with the scalp trade than you are the long-term trade. Okay, if all was equal, 70% 1-to-1, risk is the same, so on and so forth. Now, after each of those 2 pip trades, you can take additional 2 pip trades, and they're going to be worth more, right? Because your balance will increase. Your balance doesn't stay at 10,000. It goes 10,200, 10,400. Maybe you take a loser in there, and now you're back to 10,200, whatever it might be, right? And we can see that oscillation. We can see that occurring within this breakdown right here, right? We saw that we took a loss. Now the next trade, the very next trade, was 2%, and 2% of our new balance. And 2% of our new balance would have equaled, 198 or whatever it was, right? And then our lots in dollars, and then our new account balance, and so on and so forth. So our lots will change based on, even if all of this was the same, right? If this was all 70%, 2-to-1 risk to reward, risk percentage is all 2%, right? Our lots would still change. Okay, so if you're just getting started with trading and you're trading with a small lot and you never change your lot size, then you're doing it wrong and you're never going to get anywhere with that. And part of that is a fear tactic, right? I'm not saying use larger lot sizes larger than you need to. I'm saying use the correct lot size. If you have a 70% win rate, use anywhere from 0.5% to 2% risk, right? 80%, use 80 to 90, use anywhere from, 2 to 4%, 90 and above, 4 to 5%. Okay, those are just really quick, numbers that you could use. So if you're using a really small lot size, okay, and you're just using it because you're scared, you're not doing yourself any favors. Okay, so because for one, you're never going to make any money that way. And for two, you're never going to be able to overcome that fear. You're not doing yourself any favors. So at some point, maybe you've been trading for 5 years and you've been doing it right, and that 0.01 lot size, you're now, your account is much larger and you're ready to step up your game. So what do? Go to a 0.02 lot size? Like, do you go to a 0.5 lot size? What do, right? Because as soon as you do that and you see the drawdown, you see that number go negative 5, 10, 100 times larger than you're used to, it scares you. And you end up doing things that are emotional, right? So using just an arbitrary lot size is not the correct way to trade. Okay, you want to make sure that you're using the correct lot size. And we'll do a whole session on risk. Okay, maybe next time, maybe next Friday. I had some planned for next Friday, but we can do a whole session on risk, on how we determine what risk percentage we should use, because that's something that's a need, right? You don't see a lot of that online. There's not a lot of people talking about how to determine what kind of risk to use, right? More than anything, it's, well, what are you comfortable with? Well, that doesn't matter. I mean, it should if what it calls for you're uncomfortable with, perhaps. But if that's the only answer, just use whatever you're comfortable with. That's not the right answer, right? Because that's going to get you in trouble. That's why over 95% of traders are failing. They don't know this stuff. So you should know this. If you're here, I want to make sure you know it. So we'll talk about that maybe next week on our next session. We'll talk about some of that stuff. But one thing that I want you guys to be aware of is a number of brokers offer deposit bonuses, okay? So some of these bonuses are more harmful than helpful. The most common of these bonuses is a deposit bonus. A broker may offer a deposit match where every dollar you deposit into their brokerage for which to trade, they will match your deposit up to a certain amount, okay? The catch is that the match is not yours to withdraw at any time, okay? The additional amount does not count towards your margin calls, okay? So in a nutshell, the only thing this match allows you to do is to use the larger lot than would otherwise be allowed. So let's say, for example, you've got a $10,000 account or a $100 account, doesn't matter. I just like using 10 grand because it gives me room to play in either direction. Okay, you got a $10,000 account. And let's say the broker does not allow you to put in larger than the 10.0 lot size, okay? Now, you shouldn't put in a 10 lot with a $10,000 account. If you're doing that, you're gambling, and maybe you'll win, a few times, but the time that you lose is going to wipe you out, and it's going to take away all your profits. So don't do that. If you want to take day trading seriously, don't do stupid things, okay? And that's what they are. They're stupid. And if you're here, then you're not stupid, right? You're trying to further your education as a professional day trader. So don't pretend to be something you're not. Don't do stupid things, because stupid people do stupid things. So if you're not stupid, and then the proof is that you're here, you're trying to further yourself and your education. You may be uneducated in some of these things, but you're not stupid, because it takes a certain level of intelligence to identify that you need to learn additional in order to be successful. So don't do stupid things, right? Don't remove your stop loss. Don't change your trade plan in the middle of your trade. Don't do stupid things, okay? Because you're not stupid. All right. So if you've got a 10 lot, which you shouldn't be doing to begin with, right? The only thing that additional money does is make it look like you have 20K in there, right? So that you can use a larger lot size. Let's say a 20 lot, okay? Here's the problem is that none of that counts towards margin call. So that means that if your trade starts to go south, okay, let's just use the same examples. I'm going to show you real quick because this is it does nothing for you. You will not make extra money by taking that deposit bonus when it looks that way. Okay, and I'll show you one of the disclaimers here in just a moment. But don't take it for a number of reasons. For one, that different dollar amount in there is going to make it more difficult for you to calculate what risk percentage you should be using per trade. Okay, because you should be using it based on 10,000, not 20,000. Okay. Now, if we had, let's say, for every one lot, we have $650 that we're using in free margin, right? Like we were looking at before. So if we had 10 lots, then that's 6,500 just for pushing the button on that trade. Okay. So you may not even be able to put a 20 lot because as soon as you put it in, you'd get pulled out. You get taken out of that trade because 20 lots would then be 12, 13, what is that? 13,000, right? And you don't have 13,000. Okay. So this does not count, that extra money does not count towards your margin requirements or your margin calls. So if you have this 10 or let's say 15, right? So now you've got, what is that? 25, 26. So that's 87 roughly. I don't know. My math might be off, but let's just use that number. So 15 lot be like $8,700. I don't know. I didn't check my math in my brain, so I could be wrong. So $8,700, okay? And 15 lots is $150 per pip, okay? So you've got $8,700 locked up in free margin. And you have $150 every time the market moves up or down. So hopefully, right, fingers crossed, no, don't do it. But if it does move in your favor and you do take profit, awesome, you made a successful trade. But now you're convinced you've got something going on and it's going to work really well and you're going to be rich tomorrow. And all it takes is one trade to wipe you out, right? And then all that profit that you just gained is now gone. Okay, so $8,700 puts us about $1,300 away from being margin called. Okay, if each pip is $150, then 10 pips would be $1,500. So that means that you would have to make your profit in less than 10 pips of drawdown. Actually, less than that, right? Because that'd be 1,500. We only have 1,300. So you would have to do it in probably more like less than 8 pips. You would have to, the market could not draw down on you more than 8 pips. Otherwise, you would get margin called, get taken out of the trade, and then you'd be left with whatever your free margin is, collateral. Gosh, I was looking for that word. Whatever your collateral is, right? So even though your balance looked like you would have had plenty, the only thing that this does in a nutshell is just allow for you to put in a larger lot. That's it. Nothing else. It's not going to make you extra money. It's just going to confuse you. It's going to do nothing for you. Don't take it. Don't fall for it. It will jam you up, I promise. Even if you didn't over leverage, it's still more confusing to try to subtract the difference of whatever the deposit bonus is at and whatever your real balance is at. Believe me, it's a nightmare. Don't do it. It does nothing for you. It only hurts you in that situation. Now, not all of them are that way, but I'll show you an example of what one of these terms and conditions look like. So 100% welcome bonus is available to all clients making first time to trading account. Okay, so you've never used that broker before. It's the first time you're going to use them, and you deposit because they want you to deposit obviously as much as you're able to deposit all at once, so they can give you that bonus, and they want it to be a large amount, right? So if you're saying, well, I'm going to start with $100 today, but every month I'm going to put in $100, right? They want you to just put in the whole amount. So they're going to say, they're going to put something like this out there. So then in your brain, you'll say, well, I'm just going to wait then, stack up some money, and then put it in all at once because I'm going to get this deposit bonus. But this deposit bonus is garbage, right? And the broker might be great. It might be awesome. The broker might be awesome. The deposit bonus is just garbage. Don't take it. The minimum deposit required to avail the 100% welcome bonus is $100 USD or equivalent in another currency. To avail this bonus, place a request from your secure client area. So you got to go back and request it. So they don't automatically just give it to you. You have to request it. So don't act stupid, right? You're not stupid, and don't request the stupid bonus. If the total losses exceed your deposit amount, look, if the total losses exceed your deposit amount, not the bonus, if the total losses exceed your deposit amount, system will automatically stop out the positions in your trading account without any prior notification. It's margin call, right? Bonus amount would be removed if you opt to close the trading account and request for the withdrawal of complete funds. So if you had $20,000 in there and you had $20,000 of deposit bonus money, you could take out your $20,000 but not the deposit money. That would just, and it would go away. It wouldn't just stay in there. You can't trade on it. You can't do anything with it. If your money's gone, so is it. It doesn't stay in there, okay? Client incurs losses equivalent to deposit amount, right? So that would make the bonus go away. If you incurred losses, that's equivalent to your deposited amount, not the bonus and deposit amount, the deposited amount. A proportionate amount of bonus amount would be taken out from the trading account if client opts to take the principal amount withdrawal. So there would be no reduction in bonus amount if client takes profit withdrawal. So if I have $10,000 in there and I had a bonus of $10,000 and I made $10,000, now I have $20,000 plus the bonus of 10,000. So I'd show, it would look like I had 30,000 in there, but really I only have 20,000 in there. If I took 21,000 out, then that 1,000 that, or rather, sorry, 11,000 out, and it left 9,000 in there, 1,000 of that would count as my initial capital, right? Because I started with 10,000. Well, now I've taken 1,000 out of that away, and I'm withdrawing it. That means that the deposit amount goes to 9,000 as well, right? So it's proportionate to the amount that you take out of the starting capital, okay? The maximum leverage allowed under deposit bonus promotion is 200 times. So this is just the leverage, right? The 200-to-1 leverage that we're talking about when looking for a broker. So they don't allow you to use more than a 200-to-1 leverage if you're going to get the deposit bonus, which doesn't matter because that's what we recommend anyways, 200-to-1 leverage. No more than that. There's no need for all that. But I would definitely wouldn't recommend less than that. 200-to-1 is that nice sweet spot. Excuse me. The company reserves the right to hold or deny or remove the welcome bonus if client attempts to abuse or has abused the promotion or otherwise acted against the good faith. The company reserves the right to request for all additional information. Let's see, by taking an offer, customer confirms that they fully agree, understand. Yeah, that's pretty much it. So that's, I mean, in a nutshell, that's what it looks like, right? So you can see here that you can't spend it. It doesn't give you the ability to make more money. It just gives you the ability to be reckless, actually more reckless than you should be. Even with the amount that you have in your account, right? Whatever it might be, $100, $1,000, $10,000, the lot size that you could put with that, the maximum lot size you could put with that dollar amount would be too large. And I don't even know what your account balance is, but if there's a maximum lot size that you can put in, which is the case with vast majority of brokers, it's likely that that amount you shouldn't be trading on. You should not be trading, even if you have a 99% win rate, you should not be trading on whatever that amount is. It's just reckless, right? And there's no math or science that would justify doing that. And so if you do it, it's because you're gambling and you're hoping to get lucky. And maybe you do get lucky. Maybe that trade wins for you, right? And you never do it again. That's not likely. It's not like that you'll never do it again. You will do it again. If you do it once, especially if it works, you will do it again. And it only takes one time for you to do that to be completely wiped out. Right? It doesn't matter how much you have in there. There's no rule that says that the market can't take millions from you, or hundreds or thousands or singles. It doesn't matter. Whatever that amount is, you can lose. Right? So you want to make sure that you've got a plan when going into it and you execute according to your plan, because that's how you day trade smart. Right? And that's what you want to do. You don't want to be stupid. Right? You don't want to act stupid. All right, guys, that's what we have for you today. Next week, so I was going to pick up with psychology trading, but I did get a lot of questions about brokers and things like that. So I wanted to touch on that today. But I also got a lot of questions about risk, and so I do want to cover how we determine that, so that you can see that it's something that's agreeable. Right? Again, I never want you guys just to take my word for it. I don't ever want you to feel like just because someone like me says it, that you have to believe it because we know more about the market. For all you know, we don't know anything, right? But if I can show you the hard math, and I can show you how we come to those conclusions, then it's something that I think most people find is agreeable, and it's more easy to accept, and it helps with some of those psychological facets when day trading. So thank you for joining us today, guys. We'll pick back up next week, and we'll talk about risk next week. And of course, if you guys have any recommendations as to what you guys would like to see, what you guys would like to work on, if there's anything you're working on, reach out to us, email us, reach out to us on any of the social media platforms, or email, and we'll look forward to seeing your feedback, or even on this video, if there's something that you guys want to see. We monitor the comments on our videos. And so if you want to learn about something regarding day trading, or you're unclear about anything, of course, reach out. All right, have a good one, guys. Thanks, and happy trading.